U.S. government debt as a share of GDP has been steadily increasing for the past 4 decades, but this trend has been partially mitigated by falling interest rates. Because of this, interest costs have been relatively low. Many investors have come to the conclusion that the debt is irrelevant, because those who voiced concerns about its long-term viability in the late 1980s and early 1990s were wrong. As the government continues to increase its total debt outstanding, however, interest rates have recently crossed into negative territory and are trending structurally sideways to up. This means that interest costs will play a bigger role in financial planning. The United States federal government's interest payments, at $850 billion annually, have already surpassed the amount spent on the military and are expected to rise further as a result of the recent rise in interest rates. At 3.3% of GDP, interest costs are still below the high levels of 5% seen at reach in the 1980s, but they are rising from a 20-year low. This time, it looks like there is absolutely no way out. Neither the demographics nor the economy are getting any better, and there won't be another 4-decade period of steadily falling interest rates to help us out of our mounting debts and deficits. Independent investor and financial analyst Lyn Alden tweeted her thoughts on the U.S. Treasury raising its borrowing projections, despite low tax projections. She added in another tweet that liquidity precedes PMI and other measures of liquidity when trending upward. However, this year's liquidity may be affected by the debt ceiling, refill, and ongoing QT. According to her, the debt-to-GDP ratio improves when inflation is moving at a faster rate than interest rates. When that happens, debt holders are effectively experiencing a partial default as a result of inflation. However, whenever the Federal Reserve attempts to strengthen the currency with positive inflation-adjusted rates, the debt-to-GDP ratio rises sharply, and interest payments rise proportionally. As if that weren't bad enough, asset prices can be depressed by hawkish monetary policy or improvements to the fiscal budget. The problem here is that asset prices are highly correlated with tax revenues collected by the U.S. federal government. As a result, the deficit widens as tax revenues stay the same and asset prices remain unchanged. Data from the U.S. Treasury shows that the debt ceiling has been raised or suspended by Congress 78 times since 1960. This number includes 29 increases under Democratic presidents and 49 increases under Republican presidents. The government runs a deficit in most years, meaning that spending exceeds taxation, and the difference must be made up with an increase in total debt outstanding. In 1917, the U.S. federal debt was around $5.7 billion. Today it's around $31 trillion, a nominal increase of over 5,000-fold in 106 years. Government deficits mean that new debt must be issued frequently to cover the maturing debt. In recent years, most notably in 2011, Congress has used the debt ceiling as a bargaining chip to extract concessions from a presidential administration, or as a political football to advance a narrative. The narrative of fiscal constraint is frequently invoked when politicians justify their opposition to raising the debt ceiling. The debt ceiling alone is not the same thing as new spending authorization, but like many things these days, it is mostly a political fee later. Raising the debt ceiling does not authorize new spending, rather, it allows the government to continue paying its previously authorized spending obligations and can be included in the same piece of legislation. The government will have to default on the national debt, which has grown over time due to previously authorized spending obligations like Social Security and Medicare, if the debt ceiling is not raised. That is to say, the concept of fiscal constraint is relevant when deciding on new spending and taxation plans, but is irrelevant when arguing over the debt ceiling, which is about honoring existing spending commitments. Politicians can advocate for fiscal restraint by casting votes against spending increases, proposing legislation to reform and reduce ongoing spending obligations, or proposing changes to taxation and other revenue. The Federal Reserve, commercial banks, foreign governments, and other entities all use treasuries as leverage collateral. They are also used as a form of long-term savings by pension funds, insurance firms, businesses, and private investors. According to a tweet by Lyn Alden, who has also weighed in on the banking crisis, the largest banks have more cash liquidity relative to the size of their balance sheets than most other banks, meaning that when smaller banks are acquired by larger ones, it gives the Federal Reserve more time to implement its key monetary policies. She also falsely claimed in a tweet the day before that the decline in M2 was caused by a slowdown in bank lending. Alden warned in her April economic newsletter that even a short-term default could hurt the country's reputation and the businesses and people who were temporarily unable to make their payments. Since treasuries stand for the leveraged foundation upon which the system rests, a large permanent default would severely disrupt it. However, this scenario is highly improbable. Given how divisive politics have become and the size of the debt and deficits, the former scenario of a temporary default is not out of the question. She now includes a discussion of the liquidity crisis that ensued after the debt ceiling was raised in her newsletter. As Alden sees it, a deeply divided Congress and President will need to find common ground in order to move forward, and there's more than a zero chance that they'll temporarily default on their obligations before they can reach peace. After that point, however, the debt ceiling will be raised again whenever politicians and their financial backers decide it's necessary. However, the default problem then shifts to a liquidity problem, and the financial markets are still in trouble. The Federal Reserve has been destroying base money gradually since early 2022 in an effort to control inflation by raising interest rates. In general, this is bad for the value of financial assets because it drains liquidity from the system. The banking crisis in March 2023 slowed them down, as the Federal Reserve had to lend money to financial institutions. While the Federal Reserve continued to destroy base money, it simultaneously injected new liquidity into the financial system and withdrew existing liquidity, resulting in a net increase in liquidity. Although the total balance sheet is currently higher than the low point reached in March 2023, quantitative tightening is still being carried out as of this writing. However, the Treasury General Account has also been declining since late September 2022. A reduction in the Treasury General Account is good for the liquidity of the financial system, in contrast to the Federal Reserve's balance sheet. When it does a drawdown, it forces money that had been taken out of the system back in. Since September 2022, they've been significantly below their target, without debt ceiling issue of $500 billion. The Federal Reserve and the Treasury Department have been able to effectively offset each other's risk, keeping domestic liquidity relatively stable. The value of assets is generally rising. The dollar index is a group of currencies from other developed markets against which the value of the US dollar is measured. Reached its zenith at the end of September 2022 and then promptly began to decline. A weaker dollar is generally good for global liquidity because so many nations and businesses around the world have debt denominated in dollars. This has led to a flat deposit rate for both domestic and international cash as of the end of September 2022. Until this writing, Alden had a pessimistic outlook on liquidity throughout most of 2022. However, after the debt ceiling impasse materialized in January 2023, she shifted to a neutral outlook and has been following it ever since. Since March, when bank failures provided a small liquidity boost, we have indeed been in a stagnant liquidity situation. However, that next phase, a potential negative double whammy for liquidity, is coming up in a matter of months. As the Federal Reserve continues to drain liquidity from the system, the Treasury's ability to legally increase the general account back to its target level will have a negative impact on liquidity once the debt ceiling is resolved. Taking $500 billion out of bank reserves to replenish the Treasury General Account might not be sustainable, and would likely have a negative effect on financial assets given the current regulatory environment following the financial crisis of 2008. This is especially true for smaller banks. The massive deficits the United States government is running up are an underlying issue. Over the past 6 months, the federal government of the United States ran a deficit of $1.1 trillion, and large deficits are expected to continue in the future. At present, the Federal Reserve is a net seller of commercial paper issued by the Treasury. Banks aren't buying treasuries, and neither are foreign investors as a whole. The United States dollar has been the world's reserve currency for decades, but now 24 countries are working to form a strategic alliance to challenge this status. According to reports, the BRICS bloc of 5 economically similar countries is on the verge of explosive growth. A surge of interested nations would increase the alliance's size from its current core group of Brazil, Russia, India, China, and South Africa to 24. Saudi Arabia, Iran, Argentina, the United Arab Emirates, Algeria, Egypt, Bahrain, Indonesia, 2 unnamed East African countries, and 1 unnamed West African country are among the known newcomers. From a banking crisis to de-dollarization, we welcome these impending economic tumults. Thanks for watching Market Empire, where we keep you up to date with the latest developments in the financial world. If you enjoyed this video, make sure to give it a thumbs up and subscribe to our channel for more exciting content. Don't forget to hit the bell icon to get notified when we post new videos. Until next time, happy investing!